Hello and welcome to the i3 podcast, Conversations with Institutional Investors. My name is Wouter Klein and I'm the editorial director for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. That's the letter I and the number 3-invest.com. There, you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners from around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice and is intended for institutional and wholesale investors only. Please enjoy the show. Welcome to the i3 Insights podcast. I'm your host, Wouter Klein, and today we are revisiting a conversation originally published on 6 March 2019. It's a conversation with John Coombe, one of the true veterans of the investment consulting industry in Australia. John joined John A. Nolan and Associates, now known as JANA Investment Advisors, back in 1988 as the firm's very first employee. Over 3 decades, he helped grow JANA from a single client into a business advising on hundreds of billions of dollars for institutional investors across the country. In this episode, investment specialist Daniel Grioli sits down with John to talk about the early days of investment consulting, the art of backing fund managers before anybody else will, the biggest asset allocation calls of John's career, and what really separates a good fund manager from a great one. It's a conversation full of hard-won lessons from someone who's seen more than one market cycle up close, so let's get into it.
Welcome to the i3 Insights podcast. My name is Daniel Grioli and I'm the Market Fox columnist for i3 Insights. One of our aims on the podcast is to chat with a wide variety of guests drawn from different parts of the investment and finance industry. We encourage listeners to check out previous episodes of the i3 Insights podcast, where we consider all sorts of topics, including asset allocation, investing in emerging markets, after-tax investing, and quantitative investment strategies. You can also follow us on Twitter at i3invest and at market_fox. Today I am joined by John Coombe. We first met back in 2011 when I interviewed for a job with John at JANA. Fate intervened and it wasn't to be. My first impression of John was that he's more than happy to call a spade, so I'm really looking forward to this chat. For listeners in Australia, John probably needs no introduction, but for the rest of you, here's a brief intro. John is a 30-year veteran of the investment consulting business. He joined John A. Nolan and Associates, now more commonly known as JANA Investment Advisors, back in 1988 as John Nolan's first employee. JANA has grown from a single client to around 100 institutional clients with over $350 billion in client funds under advice. The firm also oversees a further $90 billion in implemented consulting portfolios for its clients. We cover so many interesting topics in the podcast, including what investment consulting was like in the early days, the traits that the best fund managers share, is asset allocation an art or a science, and much, much more. So without further ado, I'd like to welcome John to the podcast. John, thanks for joining us today.
Thank you, Daniel. How are you?
I'm great. So we usually get started by asking our guests about their background and how they got into their career. How did you get started as an investment consultant?
Well, I started as an accountant at the SEC, and I was very fortunate that a good friend of mine, Terry McCredden, who I think you know, who is now on the board of MLC Super, but was also the CEO of Telstra Super and UniSuper. I'd worked with Terry in the Treasury Department, and Terry phoned me up one day and he said, Coomesy, come and have some fun in the superannuation fund, because he was the CEO of the SEC superannuation fund, which I think at that time was something like the fourth or fifth largest super fund in Australia. And anyway, Terry said, come and have some fun. And so I joined the superannuation fund, not knowing anything about investments, but knowing a lot about a thing called a personal computer. The SEC ran everything off a big mainframe, but the superannuation fund had just bought this new investment management system that required a personal computer. And as I was the only person in the SEC who knew how to use a personal computer, Terry thought I'd be ideal for the job. So I started working with Steve Thompson, who's now at Cooper Investors and is a terrific equity investor. And Steve taught me a lot about equities, and I used to do some of the bond investing. But
do you remember what that first piece of software was?
I can't, but it's the one that all the custodians used to use for a very, very long time as their bolt-on to do Australia, because it had a tax module on the side, and I honestly can't remember the name of it. But it was interesting. Like, it was a very, very interesting time to be in the markets. So I joined in 86, and we were just selling equities all the time because the market was so, buoyant, and trading at all-time highs. And I still remember Steve and I used to get told off. We'd go to an investment committee, and John Nolan was the chair of the investment committee. And John would say, I told you guys to sell X percent of the share portfolio. And we said to him, we did. But the market had recovered it all, and we were back at the same level as previously. So I think I spent the first 2 or 3 years just selling shares all the time. But we were a big portfolio, and we got involved in things like takeover of Foster's by Elliott and BHP and all of the, the corporate shenanigans that went on in the late 80s. It was actually quite insightful as a young man doing that.
So you clearly weren't working in a fund that delegated investment management out. It sounds like you're doing everything in-house.
No, so that's the start of JANA, or John A. Nolan and Associates. So John left the SEC. He was head of finance, and he started up John Anthony Nolan and Associates, or JANA. And that was in 1987, the day after the crash was when it started. And I was fortunate. 2 days after the crash, John and I went up to Sydney to interview managers, because the SEC had decided that they would outsource part of their Aussie equities to external managers. And I met Rob Maple-Brown 2 days after the crash. I met some of the great names of the time, Sedgman and a few others, 2 days after the crash. And, 40% drop in the market in one day is just, we've not seen it again, thank goodness. I can assure you it wasn't much fun that day.
Do you remember what you were talking about at the time? Was it just the crash, or...?
No, we talked about philosophy a lot. And John, as you know, has a strong belief that the corporate culture and the corporate structure matters a lot in investment management. And he learnt that off Budge Collins in the United States. So when JANA started, we had 2 relationships, one with Intersect in Connecticut. They were the first guys to do global surveys of equity managers. And the second one was Budge Collins and Associates out of Newport Beach. And Budge ended up being PAMCO, or Collins Associates ended up being PAMCO. And essentially they used to fund up startup managers. That they always said that was where the all of the return was, and they would fund up a lot of young startups. And obviously that led into the hedge fund world eventually for them, not for JANA, but that's how that evolved, their business evolved.
Okay. So you mentioned that backing of startups early. That was going to be one of my questions later on, but you raised it, so we may as well cover it now. JANA's been quite active in that over the years, in identifying managers early. Do you think that's been a big part of your success?
Without a shadow of a doubt, I think we've helped a lot of managers get started. They've done fantastic jobs for our clients and the members who benefit from that, and it's been really interesting to see the growth in the market, in guys willing to back themselves and have a go, and ladies, sorry, but it has been really an interesting time. It started very slowly. Andrew Sisson was the first one at BEM. I suppose Robert Maple Brown really was, he probably was the first, wasn't he? And we initially we had money with Maple Brown Abbott. As I say, I think I'm the only consultant that sacked them twice. There's a long story behind that. We won't go into that one. But it has been a big part of the success. It has been where Budge was right. Like, there is this, if you can get good talent and get it early when it's not got much money, they make a substantial amount of money in the early days for your clients.
One of the criticisms that's often levelled against consultants is that they're afraid to back managers early because they're putting their reputation on the line when they take an idea to a consultant, and also that they want managers that have a lot of capacity because they need to be able to get 20 consultants into it to get scale on their research. What is it about JANA that allowed you to do something that possibly other consultants were afraid to do?
John's very entrepreneurial himself. I remember he started up JANA himself with a little bit of backing from Bruce Cook, but essentially, John is a starter of small businesses. He understands that. And I think the most important thing from our perspective is we try to make managers profitable, because the last thing you want to do, and it has happened to me once, it won't happen again, you basically back a manager but they're not profitable. Well, that's a disaster for you reputational wise, because they end up shutting down because they're not profitable, and you end up having to go and find another manager, and you do lose some credibility with clients. Look, we haven't got every startup manager right, I'll confess to that, but the hit rate's pretty high, but it's not 100%. I'd like to lie and say it was.
I'm sure there's some stories there. Maybe you feel comfortable telling us some of the ones that didn't go so well. You don't have to mention them by name, but what went wrong?
Well, generally, the one common trait in the whole, the ones that haven't worked, was the backing and the capital structure of the organisation. It wasn't that the people were poor, investors. In fact, quite the opposite. It's just that they didn't have the corporate backing, the corporate structure to enable them that startup period before you become profitable, and it put too much pressure on them. And then if you've got a team of 4 or 5, not everyone's got the same financial backing. So if you have a person who's maybe got a couple of kids, private schools, etc., they can last for a little while off their past savings. But after a while, the missus is in their ear and going, when are you going to get a real job? When are you going to be bringing in money and paying the bills? So that is generally the pressure point. The pressure point's that startup phase, that 1 or 2 years.
Okay. So coming back to the early days at JANA, you've joined John at JANA. What did you do? What did you start out doing?
I did everything. There was only 2 of us. We did.
But what was consulting like back then? What were the sort of questions you were helping your clients with?
Well, we were trying to convince clients to get out of balanced funds and into sector specialists. So I will give credit where credit's due. John basically started the trend of telling clients managers aren't good at everything. Pick them for what they're good at, give them the money in that asset class and build out a portfolio on the best managers in each asset class. So we were pretty radical in the early, it was the way the SEC was run. Like we had a team running, fixed interest, one person, a team running equities, a team running property, etc. So it wasn't like it was foreign to us. It was how we were running money at the SEC. And in fact, if you went into the bigger balance shops like BT and AMP and Colonial in those days here in Melbourne and National Mutual, they were all run on the same lines. They were all in these sector specialised areas, but the product that was sold to the marketplace was a balanced fund, and that was the thing. Most people had 3 balanced funds. MLC started its whole premise of existence in the corporate super world was we will be the medium fund in the surveys, and then you can put your hot shots either side, but we'll always give you median return in the survey. So, and it was a very successful campaign. They had 1/3 of all corporate super. So we came in with this idea that you could pick specialist managers and get a better outcome.
Okay, so what was the reception to that idea in the early days? Did people think you were crazy, or did a particular event change people's minds? Or
I think we were sort of lucky with the property boom at the end of the property boom and bust at the end of the 1990s. John had sort of formed a view that, and he was right, that property, and this was because the SEC was a big property owner. The SEC Super Fund was a big property owner. We owned properties down St Kilda Road, and we'd been selling them, right, into anyone who wanted to buy them. But there was all this property going up in Collins Street, like 336 or whatever it is across the road.
333, yeah.
333. All of those were being built at the time, and there was cranes everywhere, and the finance was, super competitive, and the banks were lending like crazy. And so we basically told our clients, don't own any property. And we took so the first 3 clients we had, if they had property, we sold it. If they were in a balance fund that had property, we got out of it. They literally had no property. And so and also we started working for Australian Super, which was ARF in those days, and we started working for Rest. And all of their money, it was a beautiful place to start. They had all of their money in either AMP Capital Guaranteed or National Mutual Capital Guaranteed. And so we had to take those portfolios and all this new cash flow and put it into asset classes that we thought were going to do okay. Well, the asset class we thought was going to do terrible was property, and so we stayed right out of it. And so these clients had a fantastic run through the first part of the early 1990s because they didn't own any property. And then we're probably the first consultant to ever do it, but we used to take the National Mutual and AMP property unit prices and actually graph them and where they were going, and that was our proxy for the Australian property market. And AMP had dropped their property unit price by something like 20%, and National Mutual had dropped theirs by 5%. There was something wrong in Melbourne at National Mutual, which subsequently there was. But so we basically said that, well, there's an anomaly here because these property prices are starting to look reasonably cheap value relative to the share market, and we did the biggest asset allocation call I think in the firm's history. Western Mining had no property. Don Morley was the chief financial officer. John went on holidays in mid-January to do his fly fishing because that's what he loves to do. And I was left with the instruction that if the stock market kept going up to a particular level, I was to call Don, and we were going to switch 10% out of equities and into AMP property unit prices.
All on one day?
All on one day. the stock market hit a high, I think it was the 18th of February. I'm not 100% certain about the date, but I think it was the 18th of February. It was up 73% in 12 months. It's the highest, I think it's historically the highest 1 year rolling 12-month return. Anyway, it was up 73%. I phoned up Don Morley and I still remember the phone call. Don goes, "Are you certain, John?" And I said, "Yes, Don," with all the conviction that I could muster.
We're on a rocket ship and you want to get off. We're about to go to the moon.
But I suppose we were lucky because the 87 crash was still fresh in people's mind. And so it wasn't that hard. Do you know what I mean? It was a hard sell, but it wasn't an impossible sell. Anyway, so we actually shifted something like 15% in the end out of equities and into property. And look, to be blunt, it was the timing from heaven because I don't know whether you remember, but in 1994, Alan Greenspan started raising interest rates.
I was in primary school.
You were in primary school. But he started raising interest rates. That was the only year that the bond market had ever lost money, right? Ever in the history, because we'd reconstructed all the history of the indices back over time. And basically, how fortuitous. Here we are in property that had been hammered, and we're out of equities, which was getting absolutely slaughtered because bond rates had risen and gone negative. So it was a lovely call.
I had the pleasure of interviewing Jeremy Grantham in his office back in February. And one of the things we spoke about was his early career and some of the early calls that he got right.
Yeah.
And in that conversation, we were discussing the importance of getting a big call right early.
Yeah.
Do you think that has been a big part of JANA's success? Like, would JANA be JANA if you hadn't have got that?
No, if we'd got that wrong, like if we seriously got that wrong, very hard to have got it wrong, to be honest, but in hindsight. But at the time it was, the stock market's up 73%. Everything looks rosy as anything, right? Coming off, interest rates falling, all of that sort of the recession we had to have. But it did look, it didn't feel like a big call. I think the next biggest call that we made in an asset allocation call was coming into 2000 in the tech boom. And we were working for Wesfarmers, and one of the premises that we sort of had from Michael Chaney, who was I think he was CFO at the time. He'd moved into the CEO job, but he basically gave us a mandate to maintain their surplus for as long as possible, and so he was our first client, 1988, and we'd kept the surplus, and then we're coming up towards the tech boom, and we convinced Michael that he should have virtually, I think we had no US equities, none whatsoever. Market was frothy, but that was a year and a half before it peaked, right? And I don't know, and you were probably still at school then, but
I'm starting to remember by this stage.
The peak happened in March 2000.
So what was that year and a half like?
It was painful. Like at rest, we'd gone down to 10% in global equities, the lowest they could go. And I remember saying to John, we can't go any lower. We honestly can't go any lower in global equities. So we're just got to be smart about it. So why don't we hire a value manager, because they've got cleaned up and they're not buying any of this crap. And we went to the rest board and we said, we're going to hire a global value manager. We're going to hire the best of the worst. Because the value managers were all terrible. They'd underperformed by 10, 15% under the index. It was terrible, right? But we hired the best of the worst, which was Brandy's in those days. And the following year, I think the US stock market was down something like 35% or something. That portfolio was up 35. Like, it was just magic. Like, 65% of the stocks hadn't risen in that rally. But in the next year, that 65 rallied, but the 35 who were trading on enormous valuations all plummeted to, and some of them didn't exist. So the market was down a lot, but the actual, by number of stocks, there was 65% rose that following year. So as long as you were in the value manager, you did okay. So that was interesting. I used to go along to events, and remember, I'd shifted up to Sydney now. I'd go along to events, and we'd done 20 pages of presentations for clients to prove why all of this technology stuff was just smoke and mirrors, and that it was always going to end in tears. Well, so we thought. And I'd go along to presentations at BT, and they were buying everything that we were saying was rubbish. and I remember having a conversation at an AMP function, and Jeff Rogers, who you know, Jeff was in the camp of, you should be in global, John, you should be in global. And I said, Jeff, so you're willing to give up franking credits and tax benefits? Because remember, it was, the full franking regime was in vogue then. You're willing to give that up just to go and buy something that has no earnings? It was quite a funny little tete-a-tete at a meeting. And I remember Michael Lillycrap from Rest, who was sitting next to me, he said, I don't know whether you won, John, but at least your point was well made.
It was entertaining. Yeah. So I can't help thinking as you're talking about these shifts, and the question of peer risk comes to mind. Were institutional investors far less concerned about what other funds were doing to make those sorts of shifts? Or a lot. But the biggest difference, right, and the biggest change in super was when the coalition had come to power. And they basically said you had to introduce choice. Choice by its very nature takes the asset allocation decision away from trustees and puts it back on the individual investor, right? That was, in my opinion, the biggest change that had happened in the super industry, because prior to that, everyone just ran their own balance fund, and you ran it based on the membership profile, in a lot of cases, defined benefit liabilities, etc. You come to the end of the 1990s, and choice is introduced. Well, by its own very nature, once you introduce 4 or 5 different options, what have you done? You've narrowed the range around which you can move the asset allocation, because if you've got a balanced option, it can't look like a growth option. It can't look like the capital stable either. So you've really narrowed this range. And I always said to anyone that wanted to listen that we were stymieing asset allocation. I think Kingy and I, Ray King, basically talked about how funds should, all of it came out of your asset allocation. I said, Ray, that's history, because once you've introduced choice and you've narrowed the range, the amount you can get out of asset allocation is narrowed in terms of its impact on your portfolio. Mm-hmm. So choice was the biggest change to that. Mm-hmm. Did choice also have an impact on the way trustees approached their roles?
Yeah, because remember, they introduced licensing of trustees. So that's why JANA sold the business to MLC NAB in 2000, because we had so many corporate, we were 80% corporate funds back in 2000, and all of them were talking about going into a master fund or, getting out of super. No corporate fund that we worked for wanted their executives having to do 30 hours of training to keep a license. They just wanted to offload their, which was a real shame.
Well, it sounds like it was quite an interesting and dynamic industry before everybody decided to give it away.
Yeah, it was, and there was lots of funds, and probably APRA didn't like the fact that there were so many corporate funds. But I mean, back in those days, super was part of the whole package that you offered people, and so government funds offered, higher levels of contribution rates. In some of the funds that we started working for, there was a staff superannuation fund, so staff members were given, bonuses and additional, contributions into their super. And then you had the wages guys, they were in a separate scheme and all that sort of stuff. So it was really seen as part of the HR benefit regime. Much, much less that today. Much, much less.
So you touched on the topic of asset allocation, and one of the things I've always wondered is you can look at, and there have been various studies, and the number varies from study to study. Some studies say it's 50%, others 75, 90 or 95% of, usually it's risk, but sometimes the studies look at return, is determined by asset allocation. Now, if that's the case, if you look at what the typical institution spends on trying to find active managers to pick stocks, the fee budget is probably somewhere between 20 and 50 times, depending on the size of the fund, what they spend their consultant for asset allocation advice. So I've always wondered what gives. If it's the most important part of your investing decision, why are you paying 20 to 50 times more for the other stuff?
Because history tells us it's the hardest game in town. And Jeremy Grantham would have touched on it.
Absolutely.
That mean reversion works, but sometimes it takes a long time to work. And sometimes you have regime changes. And I don't know whether you talked to Jeremy about, the profit share component.
We did, yes.
But GMO always had that the stock market was over-earning because, the share going to shareholders was higher than historic. Well, that has not come down. So whether that's a permanent shift, I actually do think it is a permanent shift. I think a lot of people get remunerated nowadays through share ownership. If you work for a bank or someone like that, part of your bonus is in the share, in the shares that get issued. So I think there's a higher percentage of people linked through their remuneration into the stocks of the companies they work for. But asset allocation, there's a lot of times when you shouldn't do anything. Mm-hmm. Sometimes I go along to clients and I'm thinking to myself, what am I going to tell them? Because I know markets are a little bit expensive at the moment. Like in a longer term, doesn't matter whether you look at EPS or, PEs, free cash flow, all of the matrices, it doesn't look cheap, right? No market does. But then it becomes a relative game. And am I going to take my money out of a stock market, stick it into cash at zero if I'm overseas negative, pay for my cash to sit in the bank? How foreign is that? Anyway, or put it into a bond market where I get negative real yields after inflation. Or do I live in the stock market, earn a yield, even though I know that there's going to be volatility around that capital? Well, I have learnt one thing in 30 years of consulting.
Just one?
There's one lesson you should learn, Daniel. Okay. It's a very simple lesson.
Please, enlighten us. Never
bet against the central banks.
Okay.
You can go out of business. I learnt that. Tim Hughes taught me that. He bet against the RBA back in the 1990s. He was running bond portfolios in his own little business, and he said inflation was going to get high and the Reserve Bank of Australia was not going to control inflation. He bet, put duration positions on for that outcome. 3 years later or 4 years later, he was out of business. His clients had given up on him and he was never right. The Reserve Bank has kept inflation in the range pretty much since they got the. So if central banks are pump priming in the world or their own economies, you don't want to go short equities. You seriously don't want to be short equities. You might take a little bit off the top. You might be 1 or 2% under because the valuations are high. You wouldn't punt 10.
Would you repeat your trick from the tech bubble of maybe hiring a value manager here or there to sort of fade the valuations?
Yeah, obviously, if one part of them. So you do things within asset classes, which you hope are smart, right? So if a part of the market's trading at a 25% discount to the rest of the market, what do? Well, you should go and have a real good hard look at it. There might be a structural reason why you shouldn't be there, but if there's no structural reason why you shouldn't be there, you probably should buy it, right? So you should be looking around within asset classes as to the cheapest, less risky way of investing into that. But at a broad AA, but you're a very brave person. I mean, I love risk models, but everyone knows that 90% of all risk comes from the equity market. And so it doesn't matter. As soon as I've own one equity, I'm in strife from a risk perspective. So it's a matter of, even within equities, is there somewhere in the equity market that looks much more attractive than somewhere else?
Do you find, I'd be interested because you obviously deal with more trustees than I've dealt with, but in my experience, I've found it much harder to convince trustees to make shifts within asset classes rather than between them. It always seemed easier to say we're taking money from equities or bonds rather than, we're shifting between investment grade and high yield or between emerging markets and developed markets or something like that.
Well, I think one of your...
which I've never understood why.
I think our trustees are getting more sophisticated, and I think the fact that they've got internal teams, a lot of the way they will look to their internal teams, and if their internal teams sort of go, yeah, we agree, then it's sort of, it reinforces it. It's not them making the decision so much as their team is, and they're really just backing their team and the meeting of the minds between your internal team and your consultant. It's if there was a very big differential between those things, but no trustee wants to see their consultant fighting with their internal team.
No, well, there goes their legal protection if that happens. What do they tell the judge?
Don't know.
So I'm going to put you in the hot seat now. There have been a lot of studies. I saw one recently came out of Oxford Business School.
Yep.
Calling into question the value that investment consultants add by picking managers.
Yep, I read the article.
I'd love to hear your take on it.
Maybe right. I mean, I look at our results across our client base, and we do have mixed results. But in general, in Aussie equities, our managers have added value. In global, they have, but it's been less consistent, and it's been more style and us calling different parts of the market like EM. So when we've called EM right, our clients have really benefited from that, but we've probably stayed in too long, if I'm honest, and that's sort of dragged investments down. Value's been very difficult the last 5 years in global in particular. And so if you've got a value orientation, and we do as a philosophy, have a valuation philosophy, it's been difficult. But we've done relatively well compared to others. Look, this would be my criticism of that particular study. It looked like they were looking through retail returns, not wholesale returns. If you've ever looked through those retail products, some managers have 6 or 7 different products in them, ranging from growth to value to core or whatever.
Different share classes with different fees.
Yeah, and all of that sort of stuff. So to me, I worry about that you haven't narrowed the field to being the one manager, one style. Do you know what I mean? Like, and that you're looking at pears and oranges, and some of those funds have got $1, $1 million in them, and some have got billions of dollars in them. I know which one matters the most in terms of the outcome for a lot of investors. So I read it with a lot of interest. I sort of struggle with academics looking through performance tables and performance results and coming up with conclusions, because they might well be right. But the other thing is, it also highlighted that the international consulting firms, the really big ones, have this process where they rank the managers, and therefore, if you're a client, you're meant to have, the top 3 or 4. Well, if you're one of those really big guys and you're advising, let's call it $500 billion or $1 trillion worth of investments, and you're trying to stick them all in the same manager configuration, you're just going to cause massive issues. We don't do that.
Well, you'll give up that edge that we spoke about earlier, which is backing interesting managers early. You pretty much ruled out of that.
But we would never do that anyway. We don't think there's, 4 managers should always have in a manager lineup, because it doesn't take into account the client risk profile, etc. Like some of our clients, they couldn't stand having some of the small cap guys and things that we have where, they add value over time, but they can be 5 or 6 under, in a year, right? Or our really aggressive, high octane, concentrated portfolios where they're down 5 in a quarter, up 10 over the year. Yeah, it's wonderful when they're up 10 over the year, but it's terrible when they're down 5 in a quarter. So that's the sort of, you got to have managers that fit the profile of the client as well.
Okay. So you mentioned that you're not convinced about academics looking into investment consulting. What about regulators? Consultants have received a lot of scrutiny in the UK.
Yep, and they have, and probably justifiably so. I actually made a comment after the 2000 tech bubble that I would throw all of the UK consultants in the Thames and let them drown. I mean, I think they did an appalling job. I mean, they were sitting there with, I think the average UK pension fund had something like 85% in equities, global and domestic. The interesting thing was, having had Wesfarmers, as I said before, with no US equities, we actually would have been better had we had no UK equities and no German equities, because actually those two markets performed even worse than the US, because the big telecom companies in both those markets went to extraordinary valuations.
Well, wasn't Vodafone a huge part of the UK market?
It was. Yeah. I think it was 15%. Well, so was News Corp.
And you had Nokia as well in Finland, and
So you would have been better off actually getting out of the European markets. But anyway.
Well, that moves me on nicely to my next question. How is consulting different in Australia to other countries?
Well, having never consulted in another country, I'm not, other than New Zealand, does that count? No, it does. It does.
We should say that it counts for them.
It does, and it is completely different. Let me tell you, they're much more internationally orientated and absolute return in the way they think about markets, which is quite refreshing. There are no surveys over there. They don't care, right? It's more about,
Would you end the surveys tomorrow if you could? Do you think they help?
They don't help.
I don't think members ever read them.
Members never look at them.
Yeah.
The only people who look at them are trustees and consultants.
Where I get really scared is where I see people's variable comp linked to a survey, and I've seen that a couple of times. There's some large funds that do that, and I think that's a really
mine isn't, Daniel. So
that's
you'll
good.
be pleased
mine
about
definitely
that.
isn't now.
No.
So.
But I do think it is an issue that the surveys. You could argue the survey is the collective wisdom of all participants in the super industry at a point in time. I'm not 100% certain about that, but it could well be. I did have a colleague, Rob Clark, who was the CIO at Rothschilds when they bought in that their asset allocation for their balance fund was going to be the average of all the other funds in the surveys. And he and I had wonderful debates over glasses of red wine about how, in my point of view, how stupid that was, and in his point of view, how correct it was from a business perspective. So it depends whether you're running it as a business. If you're running it as a business, I think you do have to be aware of where your competitors are, because you don't want to be sitting out on a limb for too long and it costing you your business.
Okay. What qualities would you say make a good investment consultant?
Questioning mind, willing to ask really stupid questions at times.
What's the dumbest question you've asked somebody recently? I can remember starting out, I didn't know what tracking error was. That was probably my dumbest question, figuring out what tracking error was. I still don't know that the answer's particularly useful, but...
I think I asked a bond manager about convexity once, and I clearly didn't know what I was talking about, and yet I'd managed bonds, which was clearly I'd forgotten what I'd learned. But I don't mean. I just think a consultant should have a view, but should realise that their view isn't necessarily right. It's just a view. There's nothing right or wrong in investments, really. Mm-hmm. It's just you've got a view, someone else has got a view.
You can use that. Really,
you can use that view to question someone and see the strength of their conviction and their knowledge about certain things. I used to ask people about Wesfarmers all the time, right? Wesfarmers was our first client. I got to know them really well. I even bought shares in it because I thought they're the smartest people on the block, right? I would go along to fund managers and I'd ask them about Wesfarmers. It was clear to me I knew more about Wesfarmers than the blokes who I was paying to manage money, because they clearly didn't have any clue about what management was doing within Wesfarmers. So that was, to me, it was a knowledge point for me. We worked for Main Nicholas, and I remember the company secretary at the time, I won't name his name, but he told me something, and I knew that the company was in trouble, right? I would go along and talk to my friends in the funds management world. Oh, no, wonderful company, everything's going fantastic. 3 months later, they profit announcement, everybody hates them. So, I mean, sometimes you get insight through your contacts. You shouldn't you can't obviously go out and share that, but you can test people about their knowledge about things.
Okay. So talking about fund managers, do ex-fund managers make good consultants, or is it a different skill set?
Consulting's a really funny art, because you come up with ideas, you listen to a whole lot of people, then you've got to put it into words and put it on a piece of paper, hand it to somebody else, and then debate whether you're right about the future or you're wrong about the future. But
because you're not really doing anything other than offering opinions, aren't you?
Correct. At the end of the day. I mean, that's why I worry about people who are so sure of themselves that they actually think they know what's going to happen. We're in the game about looking into the future and making educated guesses about what might happen, and then building portfolios that hopefully, can survive through those scenarios. But you really don't know which one's going to work out. Like, you have no idea. I can paint you a picture of doom and gloom, and I can paint you a picture of rosiness, and it's all in the matter of the delivery.
So I think that's a really important point about making educated guesses. And you see that in lots of different ways in investing, whether it's a stock manager getting sometimes less than half their picks correct, but still making a lot of money because the ones that they did get correct, they obviously backed.
Do you want a wonderful stat?
Sure.
There's a value manager. I asked them this question. On the first dollar they put in, the hit rate was less than 50. Their hit rate on the second dollar they put in, 52. Their hit rate on the third dollar they put in other words, wrong, 75. Right, so you think you got it right when you put your first dollar in. You still think you got it right. You've been really brave on the third dollar, right? But it's generally, if you're right, that's the one you're going to make the most out of. A really interesting stat, isn't it?
Yeah. And I've seen similar sorts of dynamics with growth managers. There's a ex-Tiger Cub I'm thinking of where his hit rate on stocks is less than 40% of his picks right, and yet the alpha has been phenomenal because where he has backed something with a larger position, his hit rate has been much higher.
But I bet you he starts slow, and as his conviction gets higher, he puts more and more in.
Sure.
Right.
You're probably right.
Yeah.
So my question is, if in so much of investing is about testing educated guesses, how do you make it easier to do that in a highly regulated, bureaucratic, committee-based, consensus decision-making environment like super? Because to me, all of those things, they almost all get in the way of taking educated guesses and testing hypotheses. So how do you manage the tension between the two?
By admitting that you don't know everything. And sometimes, and I learnt this off John actually early on, sometimes give in on the little things that really don't matter, where you're sort of like, they might be right, I might be right. I'm not going to fight over this. You can have that win, right? But a bit like Jeremy, your what's he called? Your points, your
blue chips. Is that
it's your career points.
Yeah.
When you want to throw your career on the line, keep a little bit back sometimes for the big day when you really want to have a big swing, and you got to convince people to buy the best manager in the worst part of the market, right? Because that's the time you'll make a lot of money, but you're going to have to use career points to get there. So give up on the things that, the 1% manager that doesn't make any difference. Like at the end of the day, it's not going to make one iota of a difference. But on the big one, be ready to stand up and fight hard.
Okay.
But they only come along every now and again.
So it's a bit like Warren Buffett's punch card. You got sort of 10 career calls, and if you thought of it that way, you'd be much more cautious about making sure that you...
Well, it's like today. Like we at JANA today, we probably haven't changed our asset allocation views for nearly 3 years. And you could say, "Oh, aren't you weak?" But the reality is, we've been in this hiatus of easy money for nearly 15 years, 10 years, and basically you're punting against the reserve banks of the world. Well, yeah, the regime's starting to change, but it's still easy money anywhere you look around the world. So it's right to be cautious about taking big asset allocation calls, right? Sometimes it's right to be cautious. Other times, no. You've got to stand up for your convictions and stand up and hit the table. But it's not very often.
So how do you learn when to play it safe and when to swing the bat? Is that just experience?
Getting belted up a few times. Having a few chairmen phone you up and go, "John, that didn't go so well today." No. Look, it's an art. It's relationship management, and you've got to be very careful that you don't kill the relationship because you're dogmatic about something that really you have no... Look, you might think there's a odds-on chance that you're right, but you might be wrong too. You might very well be wrong. So it's humility.
I think there's some great advice there in your comments. So you've been privileged to meet some of the best fund managers around the world.
Yep. It's one of the great highlights of my life, actually.
I'm glad to hear you say that. So you're the perfect person to ask this question to. What makes a good fund manager? What are the common traits? And on the flip side, what are the red flags where you're out of there as soon as you see them?
It isn't humility. Interestingly enough. No, actually, the really great fund managers that I've come across have an investment philosophy which they truly believe in, right? And live by it. And are 100% wedded to that process. Now, it can be a growth guy, can be a value guy, can be a quality person, but they do have a philosophy that at the end of the day, my colleagues hate me saying this, but I think 90% of returns are driven by a fund manager's investment philosophy. About 10% comes from their skill at picking some of the better stocks using that philosophy.
I agree with you. It's markets pick managers and not the other way around.
Yeah, no, but it's the conviction in the manager to stay the course. The other thing is they've generally been successful somewhere, whether it's school, sporting or somewhere, and have this desire to win. They know what winning feels like. They want to have that high again. If you like a runner, you know, who keeps running marathons and gets that adrenaline high. They know what winning's like. They like winning, and they keep wanting to win.
Okay. And on the negative side?
And probably one of the reasons why Australian fund managers aren't too bad against the rest of the world, because Australians are actually very competitive, right? The bad ones, I'm going to be really horrible here, but I'm going to say the worst ones I've come across have come out of broking, and they know how to sell a story, but they're not investors in any sense. They basically have come onto the buy side because they got sick of the sell side, but they're not great investors. Mm-hmm. You know, they listen too much. The other one is a bit of humorous when, you know, I remember walking out of one fund manager and he told me they were the smartest people in the world and they worked the hardest. And I said, so how do you know that? I said, I've been a consultant for 20 years. Tell me how you know you work the hardest. And you should have seen him trying to bullshit his way around all this. Oh, because we see them now, you know, and I'm going, you have no idea.
It's funny you say that. It's never ceased to surprise me how little fund managers really know of their competition.
No,
I was constantly amazed at that.
And it's worse when you go into the big financial centres like New York and London. I mean, I am amazed in London. It's not that big an area, let's be honest. And most
square mile and a bit in Mayfair.
But it's pretty concentrated. You go and ask a fund manager in London, who's your competitor in your space? They don't know. I mean, it's like, what?
You'd think they'd be...
They're around the corner.
Well, you'd think they'd be running into them at AGMs and they'd see each other on the register, or they'd even look at who else is on the register.
No, it's funny. Whether they don't care and they just focus on their own business.
Which is the ultimate...
I don't really understand that.
But you see, that's the ultimate irony, because their business is to be the students of business. Yeah. And if they're not applying their skills to their own business and their own industry, then what are they doing?
I do laugh at fund managers who tell me what they've told company management about how to run their businesses, and I'm thinking, boys, you don't know how to run your own business, let alone telling somebody else how to run their business. I'd have a little bit more humility, but anyway. No, to be honest, fund managers aren't great at running their own businesses. I actually do quite like guys who know they're not great at it and hire business managers or have an equity partner that does do all of that, because most of them aren't good at it.
Mm-hmm. That's an interesting observation. So in terms of funds management, it seems to be becoming more and more quantitative. Do you think that's a good or a bad thing?
I actually think it's been this way for a long time, and a lot of people haven't noticed it. But if I go back across my whole history, I think screening by style managers and other techniques like that has been going on for at least 20 odd years. So the fact that it's gone the whole hog and we've taken analysts out of it to come at outcomes, I don't know that it's any bigger. I would have argued, actually, that if I looked at what was happening, well, Ian Patrick was the one who pointed this out to me, and I should have listened to him a lot harder, I tell you. But around the 2007, 2008 area, there was a hell of a lot of money in hedge fund land being run on simple quant. Tons of it in Asia. And it had all basically started up in the prior 3 to 4 years, running long shorts, Asian equities, Aussie equities, a little bit of global. But the number of guys doing it had exploded, right? The amount of dollars on it had exploded. You had even the internal prop desks running quantitative processes as well. So I would argue that it was bigger then. Today, there's the biggest phenomena today is passive, not
smart beta as well.
Well, not really.
It's not big by size, but it's growing fast.
Oh, yeah. And there's a lot of techniques being done on it, long, short, alt betas and stuff like that. Yeah. Don't get me wrong. But I don't think it's as big if you took it in aggregate as it probably was back in 08, 07, 08. I mean, we actually, in 09, I took my medicine and we got out of nearly all of our quant because I said the regime was just wrong for quantitative techniques at that point in time. You had too much volatility in style, rotation and stuff, and we didn't really get back into quant until 2011. So quant isn't a process that works all the time, in my humble opinion. Like it works most of the time, but it can get crowded, and the value signals are classic value signals, and if value's getting hurt, trust me, your quant's going to get hurt because
the Fed has got its hand on the scale.
Yeah, well, but quant always gets hurt when value and quality get hurt. So because that's the backbone of two of the, probably half the strategy.
Mm-hmm. Performance fees, do they ever make sense? For clients, I mean. They're great for managers, but...
Well, I've gone from a fund that wouldn't hire a manager unless they did a performance fee. I'm not naming names here, but they would have had at one stage 80% of all of their equity bond managers on performance fees. They thought it incentivised better outcomes. I don't think it changed the outcome. I don't think a manager tries harder just because he's got a performance fee regime than he does if he was just running a... Now, I'm talking long only there. I then go into the hedge fund world, and I think performance fees drives everything. I think they're structured wrong. Performance fees off cash are just...
Totally wrong, because it's a benchmark that doesn't reflect the risk.
It feels wrong. It feels like a transfer of wealth that I actually think we'll look back in history, and some of the hedge funds, we will look back and say that is, in history's eyes, the greatest transfer of wealth from the people who had it to the people who wanted it. And they didn't give you much back in return for it. I don't mind paying like a performance fee to a private equity guy who's doing 14s, 15s, maybe 24s. Like, it feels good to pay someone like that. I remember at the SEC when I first started in super, we hired some of those baby tigers that you talked about earlier because Collins had put us into them. And I remember we wrote out a $21 million, this is my memory, back in 1986, we wrote out a $21 million check to one of the tigers. And the trustee board hated it so much that we sacked that manager the following year. It's terrible, but it was
stuck
true.
in their throat, was it?
It stuck in their throat. Like, they couldn't stomach paying. And that was I think that was a 20% take. So he'd made 120 for us. We paid him 20, but they couldn't stomach paying the 20. It's funny, isn't it?
It's a very behavioural thing, isn't it? Some of our listeners are fund managers. What tips can you give them if they
Are they
happen
going to talk to
your
me
office?
anymore, Daniel?
I don't know. I think so. I would.
Come with a good business case. Don't walk in with a wish list. You got to know certain things before you walk in and present how you're going to operate. What's my capital structure look like? What's my investment philosophy? In what markets am I going to make money? In what markets am I going to struggle? How much do I need to be break even? What does my team look like if I'm successful? You'd be surprised at how many you ask that question and they have no idea. And it's sort of like, well, you might operate in the early days on the smell of an oily rag, but if you are successful as a fund management business, you are going to need more people. And you should have that built into your business plan. How long can I last, before it really hurts if I'm funding it myself? How long is my funding partner going to stay with me? Right? Those fundamental questions have to be answerable, maybe not on the first meeting, but definitely by the time you've come back and seen me the second time. First time you might ask me a few questions about what should I do. The second time you better have answered those questions and come in with a business plan, because you can't walk into Ian Patrick at Sunsuper and say, look, Ian, back me, I've got no backers, I don't know what, I just want to do this. Like, you've got to go into a big fund like Sunsuper with how you're going to make them money and make their members better off, etc., or Rest or anyone. Like, you've got to have a value proposition.
How often would you see managers come in with a half-baked business plan?
Well, it depends whether it's that first meeting or the second. Usually by the second, they've got it worked out. The first one might be a little bit iffy, right? But we're in a privileged position because, as you know, you talked about it before, we have backed a number of firms over the years, and a lot of young people who want to start up do come and ask, a little bit of advice. And I've given it free today, so they don't have to buy me a coffee anymore, which is good. I'll keep the weight off. So I do think you've got to understand what the business is going to look like in your growth phase and in your mature phase. It's very interesting. Guys know what it looks like and how hard it might be in the growth phase, but they haven't necessarily worked out the economics in the mature phase. And the backers of boutiques are almost in a similar boat. Some of them have got it right now, but in the old days, we take X all the way through, blah, blah, blah. And when they're really successful, you know what? That X is a big number, and the guys who are running the money don't like it.
Yeah. And
so there has to be a recognition of a mature business as opposed to a growing business.
That's a really good point. If things go badly, well, the backers have generally risked money they could afford to lose. The person having a go or persons having a go have lost. But it also
hurt their career for a very long period of time.
So they're the ones really taking the risk. But as you say, it's the arguments happen when things go right, because that's when everybody's unhappy about their respective slice of the
cake
of the pie. Yeah.
Yeah, no, it's a real issue.
You touched on this very early on in our conversation. I just wanted to come back to it in a bit more detail. So JANA started out as a privately owned firm.
Yep.
Then it became part of a much larger public firm.
Yep.
And now it's a private firm again.
Part private.
Part private.
Yep.
So some of your competitors are divisions of public companies, and some of them are owned by their clients. Do you think the business model of a consultant matters?
I do. I'm going to hedge my bets here, because I do think if I was running a big multinational, and I'm not saying, we all know who those guys are. If I was running them, I have to be a big part of a big organisation, because I'm going to go into markets where I need some backing, because I might be in those markets for 3-4 years, not making any money, in fact losing money because I've hired people. And I've met my contemporaries in places like Hong Kong and Seoul, Korea, and in Japan, and like they can go 5 years and they're not they're nowhere near break even, right? So you need, if you're really big global, you do need to be a part of a big organisation with big, deep pockets. And let's be honest, the big ones nowadays are part owned by insurance companies, or they're part owned by fund managers or life companies, etc. So those people have got deep pockets.
But their consulting business is generally a rounding error on the company's revenues and
not
accounts.
Not necessarily if they're into the outsourced CIO model. And look, having just gone
to
the US, if you think the UK has done it, it's nothing compared to what is happening in the US, where you've got small government funds outsourcing the CIO thing. And it's not just the consulting firms. It's the Vanguards, the Morgan Stanleys, the Goldman Sachs. Everyone's in the game. Mm-hmm. And I'm telling you, it's a very, very competitive game.
Is that going to happen here in Australia?
No, I don't. Well, I think it did. That was called exit corporate super, left, right and centre. It happened. No, I think we're in a consolidation phase here. But so my answer is, I think it depends on how big you want to be. If you want to stay in your own market and just be excellent at what you do within your own hemisphere, you probably get away with employee ownership, and that's probably the best model, because you've got buy-in from all the senior consultants. But then, as we all know, it comes to the point of changeover from one generation to the next generation, and have you got that right in terms of the next generation owning the equity already, building up their equity over time as they become more important in the business, and at the end, taking the senior consultants out in an orderly fashion and not causing a corporate event, which when you look overseas, whether it's funds managers or consultants, that's what's generally happened. You got this generation, and then they haven't given them equity away to the next generation, or not given it away, but haven't filtered it down. Yeah. They haven't filtered the equity down over time, and so they end up being this massive equity holder, and they need a corporate event to extract their wealth because the guys underneath can't afford it.
Okay.
So I think it depends what you want to be. If you want to be the biggest consultant in the world, you better have somebody who's got a big checkbook.
So in terms of consultants, there used to be 4 main ones in Australia institutionally, a lot of others, but sort of...
In the 1990s, there were 20.
There were 20. Well, now you could argue there's almost only 2, really, of any size. I won't say who they are. But whether it's 2, 4 or some other number, is it now getting a bit too concentrated? Is there enough diversity of views? And
no, it's no way. It's no way it's that concentrated. I'd argue today there's 20 consulting firms. There's 15 sitting in funds, Aussie Super, Sun Super, etc., etc.
So you're saying
right?
it's okay because people are internalising?
Yeah. Well, they've internalised part of the consulting function, right? So there's not the 4 or 5 of us. We're an add-on to the internal teams now. We're helping internal teams. We're providing breadth. They provide the depth. And so I don't think there's only 4. I think there's something like 15 because of the internalised teams.
That's an interesting take on the concentration issue. So moving on to the home stretch, I have a couple of quick questions aimed more
So
at...
is this hard? I've got 5 seconds to answer each question.
No, you can take longer than 5 seconds, but
Right.
I'd like to sort of finish up on a note where we have some practical tips for institutional investors, whether they be your clients or other institutions. So what are some common mistakes that you see institutions making that they should avoid?
I think the sole purpose test is a wonderful test. Don't get distracted by all of the other things around super. Concentrate on, delivering member returns. You can get a little bit distracted at times around the peripheral.
Mm-hmm. I think that's good advice. Most institutional balance funds have CPI plus 4 or 5% targets. Are they realistically achievable? And if so, what can funds do to achieve them?
They're more like 3.5 for a balanced fund nowadays, but they're achievable on the numbers. But we don't need any big mistakes in the world. Look, the margin over inflation that we're going to achieve over the next decade is going to be lower than the margin that we have achieved over the last 10 years because of where we're starting from, right? And when we went back if I was in 98 and we'd had this conversation, I would have said that for the next decade, the returns you're going to get out of a super fund are going to be lower than the decade before because of where the starting point is. I do agree with Jeremy here, right? The starting point is vitally important about what you expect over the next decade. And the starting point, we're starting it relatively expensive in a historical context. So if we stay expensive over the 10 years, we'll probably get a balanced return of CPI plus 3, okay. But if we go from expensive to cheap, the next decade could be quite difficult because we're starting expensive.
Okay.
And how can they achieve it? I wasn't a great believer in private equity back in the old days. I was a bit sceptical. But when you look at what our funds have been able to achieve in owning businesses in the infrastructure space, and I would also add in owning properties in the property space, and if they do private equity well, the sort of returns that you can generate out of a good private equity program, doing a lot of co-investments and things like that. I think owning businesses, owning the capital structure, owning how you allocate capital across that and when to allocate, you're in control. If you do that well, if you really do that well, there's a lot of money to be made.
And you're not worried that those businesses are more expensive than public equities and there's a lot of money chasing them?
No, because yes, of course. But if you own a great business and you got good management and you've incentivized them right, the fact that you own when you're going to put more capital into the business to help it expand, when you're going to drag out your dividends and there's no, like you're in control. And if you do it really well, I do think they're wonderful ways of wealth generation.
Okay. So what would you say are the biggest challenges facing institutional investors at the moment?
Getting set into the assets we just talked about, because you're right. There's lots of people who've decided what I've just articulated, and there's a lot of them trying to get into that space. And And a lot of them are saying, like for the next decade or so, I'm in a growth phase. And then after that, I'm in a sort of mature phase. And so in the growth phase, they're getting set into these businesses and they're paying up to get set. Now, only time will tell if they've paid too much. And then it'd be lovely if you could buy these wonderful businesses at half what, we have to pay today. But we are in a competitive space. And the one bit of warning I'd say to all of us is the world has much more savings today than historically has ever been the case. If you look at China, you took 500 million people, 500 million, you took them out of poverty and you have turned them into capitalist savings machines. They're looking for investments. They're looking for places to put their money as well. It's 500 million people extra. And that doesn't account for all the extra wealth that you've seen the average Australian generate, the average person in the UK generate, or the average person in America generate. Every one of those people is looking for somewhere to put their money and generate a real rate of return. We're in a world full of money looking for investment return.
Okay, so final question. What are 3 things that institutions can do to improve their investment decision making?
We talked about philosophy before. Be very certain about what your investment philosophy is. It will save you in all circumstances. If you have a belief system, it will stand you in really good stead going into the future. You won't get everything right, but you have a story to tell to your ultimate member. We're managing the money this way. We're doing it this way for these reasons. And as long as you're disciplined in that, you will win in the longer term. Whether you're growth or value, like I'm just saying, like you win in the end if you're disciplined. It's the ones who waver between, what they believe one minute and what and believe the next. They're the ones that'll get into trouble.
Okay. John, it's been an absolute pleasure having you on the podcast. Hopefully we can have you on again as a guest in the future.
Thank you, Daniel, and all the best.
Thank you for listening to the i3 podcast. For more information, please visit our website at www.i3, that's the letter I, the number 3-invest.com. And don't forget to like, subscribe and review. Thank you very much.